If you're invested in gold or gold miners or wondering if you've missed the gold boat, this episode is a must listen. Roscoe Widdup is a former Goldman Sachs mining analyst and set up a fund with a single purpose: to extract the most amount of value out of the gold cycle as possible. Now, before you dismiss this as just a fund manager talking his book, Roscoe has his and his family's wealth in the fund and very bluntly says he will close the fund and return the cash when the cycle peaks and the future returns are no longer attractive. It's in his best interest. This is a deep exploration of the supply and demand drivers of gold and what to look for in a gold miner. Finally, Roscoe thinks you have not missed the boat, and the current sideways market for gold provides an attractive entry point. This is Roscoe Widdup from 888 Capital. Right, Roscoe, why did you establish a gold fund?
We observed that the investment market and funds management industry was being hollowed out by passive. And it's even more obvious now as we move into the AI age, and we're really yet to see AI really disrupt the investment industry. But our view was, to be successful with that backdrop, you need to be doing something really specialised. Niche, maybe, if you think about a gold fund, but really specialised, and where you can genuinely attribute the best investment ideas. You can find investment ideas through genuine old-fashioned research and things that are going to be off the beaten track for passive, hard for passive to do, and ultimately probably hard for AI to do.
Why is it, and we're going to get into your investment process, we're going to get right down into gold, but I just want to come back to that. Why is it hard for passive to do it?
If you think about a gold mine, so we have a fund that invests in established gold miners, and a gold mine is a finite asset. It doesn't go forever. And every gold mining company is just a portfolio of finite assets. And there are things that you cannot escape. And so if you look at the major indices, that there are passive products that follow, they contain probably 60 or 70 established gold miners, and then maybe a tail of juniors as well. But we would say of that 60 to 70, a third are going out on the way of going out of business, a third are going nowhere, and the last third, within that last third, that's where you can find the real gems that you can identify and evaluate using research and analysis, old-fashioned research and analysis, and you can come up with an investment thesis that's genuinely actionable, genuinely unique.
I'm going to come back to that because I want to learn how you identify, how myself, the listeners and whatnot, can actually identify what stage those businesses are in. But let's come back to why then gold? Why was that the area that you chose to go deep in and provide additional value on that that others can't?
A few reasons. It's first its vitality or its criticality in the world. Secondly, the way that vitality and criticality is misunderstood. It has cycles. It is cyclical. It has typically generally long cycles, which there's something to invest in over not just a flash in the pan. Those would be the key things. Now, what's the general perception about gold? We would observe many of the general perceptions are incorrect about gold. What we believe, what is gold? What is gold bullion, and why, and who buys it, and what role does it serve in our world? Warren Buffett's famous for saying that gold serves no purpose. All it does is sit there and look at you. And if you were to look at actual demand, 50% of demand is jewelry. Does that mean is it a consumer good? We all know that central banks own and buy a lot of it. There's a long history there. Does that mean what is it? We observe that gold bullion has a number of really unique characteristics that give it the attributes of a store of wealth. Now, what are those characteristics? The first is that there is genuine intrinsic value. Now, is that around a belief system? Yes, of course, it's a belief, but that's a belief system that's existed in humanity for thousands of years. There's no question that there's a significant number of humans who believe there's value in some metal. That value does not require a counterparty. If you are holding the gold, you have the value in your hand. There is zero duration to that value. If you reflect on many other assets out there, there's a counterparty, there's a promise, there's a duration to unlocking that value. Take US Treasuries, a 10-year Treasury. It's a 10-year duration. There is, in this world where we have a little bit more geopolitical conflict, it'd be fair to say, than what we've had for a few decades prior, it is geopolitically neutral. Let's reflect on what happened in the second quarter of 2022 when Russia invaded Ukraine and the major powers seized its foreign reserves and kicked it out of the SWIFT payment system. Every central bank on the planet took note, and that's the most important thing really that's happened in the last 5 years. Central banks started buying gold again. Now, why are they buying that? It's because of those store of wealth characteristics. It is geopolitically neutral. It is the ballast within our financial system. And as our financial system gets larger and more complicated, we need to hold more reserves. We need more ballast in that system. And that's the reason d'etre for gold. Now, okay, jewelry is 50%. Why is jewelry 50%? Does that mean it's got attributes of a consumer product? No. 2/3 to 3/4 of that jewelry demand is India and China. We would reflect that demand is actually store of wealth, investment in ring or bracelet or necklace form, rather than in ingot or coin or bar form as it would be in other economies.
And coming back to the central bank buying, what would stop the central banks from buying?
Well, things have stopped central banks from buying in the past. At the end of the Soviet Union, fall of the Berlin Wall, central banks were selling gold. And they sold a significant amount of gold right up until the financial crisis. There was an accord called the Washington Accord that occurred in 1999, which put a framework and some limitations around how much central banks would sell. But central banks sold in the order of 6,000 tonnes of gold then, only stopped in the financial crisis, and emerging market central banks bought for the bit more than a decade after that. And then we started to see developed economy central banks buying again for the first time really since the Cold War. As it stands, as I mentioned before, that when Russia invaded Ukraine, central banks really started buying gold again. Prior to that, central bank demand was about 10% of global demand. It doubled to 20%, and that's where it's stayed since. That level of gold demand from central banks hasn't been seen since the 50s or the 60s.
And so right now, you combine all of this and you get to a situation where gold is at all-time highs, gold miners are viewed as incredibly expensive. Yep, you remain quite bullish. Why is that?
There are two things to talk about there. There's the first, that gold is expensive, but the second is that gold miners are incredibly expensive. I don't want to verbal you, but incredibly expensive. I think some of the reflections on Australian gold miners are that it would be consensus that Australian gold miners are fully valued. Some might be described as expensive. That's only part of the story. Gold miners, we would observe that gold miners that are listed in Canada and the United States are actually really, really attractively valued, really cheap in terms of their valuations. And that's not just our view, that would be a broad consensus. But coming from Australia, a lot of Australians don't see very much further than what's listed here. And that represents an opportunity. Now, and then gold as a gold bullion at near to or very close to all-time highs, does that make it expensive? what we would say there is that you first of all need to adjust the gold price. We need to index it to inflation and look at the inflation-adjusted gold price through time. That tells part of the story. But the second thing is that there is such a thing as inflation in producing gold itself. So there is gold mining specific inflation that you need to incorporate. Because if you go back 20, 30, 40 years, the grade that was being mined, the permitting, the cost of permitting, the lead time to get into production, the labour cost, the energy, everything is different today. Everything has inflated. And if you adjust the long-term gold price for those structural inflation factors, the gold price is at a healthy level, but certainly not elevated.
Okay, so your fund, you invest in gold miners and along that value chain. You don't specifically just invest in the commodity like gold itself. Is that correct?
No. If we look back at gold's performance over time, let me explain that. If you look back over 20, 25, 30 years, gold bullion, boring old gold bullion, which has a negative holding cost and generates no income, no dividend yield, has been among, if not the best performing asset class on the street, notwithstanding those characteristics. And really, irrespective of where you draw that line, our view is that that's as a result of gold's fundamentals, the combination of demand factors and supply factors, steady growing demand and structural constraints on the supply side. Our view is that those trends continue in the long term over the next 10 to 20 years. And we believe that gold bullion will be among the best performing asset classes on a 10 to 20 year view. Gold miners produce that asset and make a margin doing so. That profit margin in a rising gold market increases by more than the movement in the gold price because it's a subset thereof. Therefore, there is the potential with an actively managed portfolio, being mindful that they are finite assets and gold miners are portfolios of finite assets. There is the opportunity to generate superior performance to the gold bullion price, a leveraged performance to the gold bullion price through those profit margins. And that's what we've set out to do. So
let's now have a look at those businesses. Let's talk about those life stages that those businesses go through, and where you choose to invest in that cycle, and then we can talk about as well how you build a portfolio around. Like perhaps you'll build a portfolio around the companies at different life stages of that cycle. So can you walk us through those and what the characteristics and how you'd identify them? If we're just in front of if we're looking at their annual reports and things like that.
Well, life cycle of a gold mine: discovery, development, production, and end of life. And there are more twists and turns than that, but that's oversimplifying it. But then remember, in an established gold mine, so a mine that's been brought into production, there are phases in a neutral gold price environment where that mine will consume cash, and there'll be phases where it produces cash, where you need to transition a mine from open pit to underground, consumes cash, where you need to do another cutback on an open pit, consumes cash. We very much have a preference for those gold mining companies that are not doing so much of that stuff, and we actively manage the portfolio to focus our portfolio on companies that are in the cash flow generation phase rather than the cash flow consumption phase.
Right, so they've done their exploration, they've done the development of the mine, and they're in there extracting.
Correct. And to go back to that earlier example, not at the end of the life of the pit where they're about to go underground and spend all that money, where they've spent all that money and they are now at a stage where they're generating and producing cash flow.
And so for you then, there would be different gold miners at those different at that same stage, but what separates the good from the bad? What makes a good miner versus a bad miner, and how can we identify that?
We look at a number of target characteristics. And the first is, and this first would be probably different to a lot of what a lot of other mining investors would say. A lot of other mining investors would say we start by looking at management. We look at management last. And the reason for that is that you can't, it's really difficult to change your fundamental endowment. So we start by looking at the fundamentals of the mines themselves. Are they good mines or bad mines? Second, we look at what's something else you can't change, country risk, where they are located. You cannot move a mine to a different country. And the difference between a good country and a bad country in terms of a mine's location is that you could lose that mine. You could have, which is it can be an existential risk for a company.
What's a good countries versus bad countries?
We describe, and we've heard others describe it as this as well, so we're not the original to describe it as, but we describe countries as being part of the AK-47 nations or not.
AK-47
countries that are ruled with the AK-47 rather than the rule of law. We have a very strong preference for rule of law countries, and it can be unavoidable to be exposed to some countries that are elevated country risk, but we actively avoid excessive concentrations of those or too much of that in our portfolio.
Whereabouts are they typically located?
Some of the less fortunate parts of West Africa would be the top of the list. Some of the parts of Central Africa, top of the list.
And where does that leave the main kind of cohort of mines that you invest in?
With geologically, gold endowment across our globe is pretty evenly endowed. The top three nations, the top three countries by production are, and I'm not sure, I couldn't tell you the exact order, but it's Australia, China and Russia. Mm-hmm. Russia would be, it's not an AK-47 nation, but it's not a desirable place to invest from our perspective, nor is it even possible. But geologically, if you take the borders away, it's again relatively evenly endowed across countries. Where we find it more attractive to invest is in Australia, North America, parts of Latin America. Now, the most prolific and growing area of the world for gold production is West Africa, but that brings a whole lot of risks.
And you've got to weigh those risks up. So we've had essentially the resource, like what they actually have, the size of the endowment, and we've then got the country risk.
Fundamentals, country risk, staying power, typically through balance sheet. Do they have we don't have the appetite to invest in highly levered balance sheets. There's enough other risk to contend with there.
So they can self-fund.
Correct. Or then they're not trying to pay down debt before they pay back equity holders. That cash flow that we're anticipating them generating comes to us first. Fourth, there are a lot of different ways to operate a mine and to be, from an environmental perspective, from a local community perspective, the way the workforce and contractors are treated. We look for miners that behave in a responsible way. Miners that behave in a responsible way, in our view, generate better risk-adjusted returns over time. So we look at, there are some established standards on responsible mining and responsible gold mining provided by the World Gold Council, and among others. But we look at those factors and we do our own due diligence on those factors as well. Lastly, competitive advantage. And this is where you'd look at management. Is management part of the competitive advantage of the company? Do they add value? Do the skills that sit within that company, for example, the ability to develop and operate within complex geological environments, geotechnical environments, to run really profitable undergrounds, they're the sorts of things that are part of a gold mining company's competitive advantage. We look at all of those factors It's the score, the identification and scoring of those characteristics that identify what have the potential to be the most attractive and valuable gold miners. Then we do our own valuations, and we evaluate these companies and come up with a valuation that relative to the stock price is either cheap or it's not. And then we do a risk assessment from 3 different perspectives. Bottom-up fundamentals, which look at the individual bottom-up risks in terms of project execution. It does look at country risk. Those bottom-up factors within a company. We also look at from a responsible investment and ESG perspective. Gold mining and mining, that it is a minefield of risks from that perspective, and that is a really critical and important part of the evaluation, the risk assessment process. And then thirdly, we look at quantitative measures. Is there anything hiding there that can give us a sharper lens on risk?
And do you go out and actually visit these places as well before making the investment? Do you essentially, I guess with the numbers, trust but verify?
Yeah, trust but verify. But look, these places are really can be very, very difficult to get to. We rarely visit. In a former life, I spent a lot of time doing that. In today's...
What was that former life?
I spent the biggest part of my career at Goldman Sachs, investing in natural resources companies, mining, energy, utilities principally. In this world where disclosure is increasingly regulated and where we are investing in established, often relatively high-profile, well-controlled companies, there is not a measurable advantage as an investor to go and visit the site.
If you're looking at that return on time.
Correct.
How much value does that add versus the rest of the work that you've done?
Correct. And the management teams are accessible globally now.
During earnings calls, things like that.
But also one-on-one, which we do a lot of. And through video conferencing, the value of those conversations, the richness of those conversations has enhanced relative to the days of teleconference.
What are some of the questions that you're asking management on those calls to get a grip on their ability?
There are a couple of questions we always start with. First of all, we can't help asking how they're seeing the cycle, because it is a cycle. How are they seeing the cycle? Where are we in the cycle? And then how does that nuance their strategy or dictate their strategy? We also ask them, where do they expect to be on a 3, 4, 5 year time frame? What we're investing for the long term. So what beyond 12-month guidance, what should we expect it should look like in that time frame? And we like to get a really good picture and get aligned with management on that. We also ask them, a standing question is that if gold prices go up a lot, what do you do? We are most of all looking for companies where the profit margins increase. One of the consensus negative perceptions of gold miners is that when the gold price goes up, costs go up. We've seen that at different points in the cycle before. Our belief and our thesis at this point in time is on over a 1 to 2 to 3 year view. We don't believe, our research indicates, we're not going to see extraordinary cost inflation in gold mining, even with higher and higher gold prices. What does happen within gold miners in response to higher prices is many gold miners, and this is the reason we ask the question, many gold mining companies with higher prices where they have short mine lives, they will reduce the grade that they're processing. That will reduce production. Because of the higher price, their revenue remains about the same, and they extend their mine life. They spread that mine life over a longer period of time. And that's a characteristic first phase of a supply rebalancing cycle within the gold industry. And what that does, that actually shrinks the cost curve and steepens the cost curve. And that's within the first phase of a supply response, that's what continues to drive prices higher. That's a characteristic of the cycle, but we like to be exposed to the profit margins that continue to benefit from those higher prices.
So with someone taking a step back and wanting to create a bit of a short list themselves of gold miners to go out there and maybe put some of this information into action, what is the size of the investable universe? It's just how many gold miners are there that are in countries with sound rule of law, and that first tick that investable universe box?
Well, as we said before, if there are 60 to 70 liquid, established, listed gold miners in the world, 60 to 70, we would say a third are going backwards and going out of business, a third are going nowhere, and within the last third, so let's say 20 or a bit more than 20, that's the investable universe, in our view, where you can identify some really attractive companies. Now, going back to your very first question, why? What are some of the key reasons that we did this? Is that identifying those companies and doing that work and coming up with those valuations is not for the faint-hearted. It's a very specialised exercise, and picking your own stocks and having to watch them day in, day out and keep up with what they're doing is technically intensive, requires a lot of experience, and it's incredibly time-consuming. Therein is part of the thesis for investing in a fund like ours. The other part of the thesis is that just go passive. Why not go passive? Well, because 2/3 of what you're buying in passive, according to our thesis, you don't want to own. You don't want to be part of.
How do you guys, and so how many companies does that mean you generally end up holding?
Between 15 and 20.
Between the 15 and 20. And then what would you benchmark? What's a benchmark for yourselves? Is it against that broader gold miner index, or is it against the gold price, or it's the gold miner index?
It's the gold miners index. Now, in all of our reporting, we publish what's happened to the gold price as well. That is the base law of physics.
Because I'd imagine someone sitting out there would probably say to themselves, and I'd love to hear your answer to this, why would I go down that path when I could just, I understand why I want some gold exposure. I'm just going to get one of these 3 or 4 gold ETFs. Why would they go down the path of, is it a trade-off, or could they, in a portfolio construction point of view to your allocation of gold, can you have both? Or how do they work alongside each other, or not at all?
Let me start with this, and this is general advice, and with the disclaimer that everyone should get advice from a licensed finance professional that is with a mind to their own needs and financial situation. But when sophisticated investors ask us about allocating to gold and allocating to gold through cycles, what do we say? And what we say would be more or less consistent with other specialised gold investment firms around the world. And we would say that of your liquid investment portfolio, there is a place for 10% allocation to gold bullion, boring old, negative carry, no income gold bullion, and somewhere between 0 and 5% to gold miners. Why 0? Because they are, if gold is cyclical, gold miners are deeply cyclical, and there are points in time when you should not own gold miners, where the cycle is really working against them and their own cycles are working against them. And we saw that in the 2012, 13, 14 period.
So what are those indicators where it's bottom of the cycle or top of when the cycle's turning and you don't want to be owning them?
Well, let's start with where are we now? Let's get to that. But where are we now? And why are we so excited? But then also, what do we do at the end of the cycle? If I've said that... Do
you go to cash? What do you do?
In this case, this is a very specialised fund. We close the fund and return capital to shareholders. That is what we will do at the end of the cycle. Now, there is the potential that we could pivot it in some way, but it'll be with the permission of all of our investors.
Right. So it's when that cycle turns for you guys, it's right, this has done its job.
Correct. And so something's got to be pretty attractive to motivate you to create a fund that you will ultimately close at the top of the cycle when you believe the returns have been generated and you won't just ride it on forever. We've got a lot of our own money invested in this, and so our interests are perfectly aligned with investors.
Right, so you guys personally invest in the fund. That's great to see, rather than saying, hey, well, we're personally invested by being shareholders of the business, and so we benefit if the fund benefits, but you're in the fund.
Correct. And we have, my wife and I have just allocated more capital to the fund. We came in, there's monthly liquidity in our fund, and we invested more at the end of June for July.
Let's go back to where we are with the cycle.
Yeah.
So where are we currently then, and what are those indicators that you're looking for and talking to shareholders or investors about and saying, look, this might indicate a top of the cycle, or this might indicate when, hey, we've reached peak return.
But also, it's just before we get into that, we've got to cover off on that question we didn't fully answer before, which was, but why gold miners over gold?
Oh, yeah.
All right. So remember, gold is no income, no dividend, but probably what you would say a tolerable level of volatility for a portfolio. Gold miners have that dividend, have incredible growth potential because of they're leveraged, and we would say 2 to 2.5 times leveraged. So if the gold price goes up by 1 unit, a portfolio of gold miners you would expect to go up by 2 to 2.5 units. So that's a considerable amount of leverage. So if you are bullish on gold miners are a leveraged way to play that. And where we believe there is a long-term opportunity for gold price appreciation, gold miners will deliver that. Does that answer that part?
Yeah.
Yeah. Now, where are we in the cycle? So I think, as we said before, gold is actually a really boring commodity. Demand growth is lower than the other commodities, slow, longer cycle. To give you, over the last 10 to 15 years, gold demand has grown by about 1% per annum. Really boring compared to something like copper or oil, other commodities that at a much higher growth. But the supply side is structurally constrained. So small amounts of demand against a constrained supply side can equal high prices. The biggest thing that's happened, as we said before, in the last 5 years is central banks doubling their rate of demand. Studying history and our analysis on the topic is that central banks, there's a lot of groupthink there, and that level of demand, that activity, is not likely to be a flash in the pan, that will be a secular theme within gold demand. The catalyst 18 months ago, which kicked off the gold, this really powerful gold price move from around $2,000 an ounce to the $3,400 an ounce or thereabouts that we are today. The catalyst that kicked that off was that elevated level of central bank buying, and then the major swing factor in markets, in the gold market, which is gold-backed ETFs. Gold-backed ETFs are a really unique feature of the gold market. They account for demand at part of the cycle and supply in another part of the cycle. And it's material. It's between 5 to 10% of demand and supply, depending whether they're accumulating or liquidating. Those gold miners have been liquidating, driven by the interest rate cycle from the last quarter of 2020. And as the rate cuts were starting in the first half of 2024, they swung to accumulating. And the coincidence of those two demand drivers at the same time against a tight and constrained supply side is what has driven the gold price higher. So when we think about where we are now, we look at demand and supply. So where is the incremental demand going to come from? Our view and our research indicates that central bank demand is likely to remain at the very least constant. A factor that we see and a theme at play there in central bank gold demand is within their reserves. There appears to be a diversification trade away from US treasuries and into substituting it with gold as a safe haven. we see that as having the potential to further increase gold demand. Secondly, outside of central banks and big investors who hold foreign holders of US treasuries, what might those holders of treasuries be thinking in the current environment? Following the election of President Trump, they are facing a little bit more uncertain trade policy, very, very elevated, significantly elevated debt levels, significant budget deficits that are increasing that debt level. There has been within defence relationships of being shaken up. There is a lot of uncertainty in relation to the US economy, and that could be a motivator for people to diversify out of treasuries into safer asset classes like gold. And then there is the financial markets through these gold ETFs. It might surprise you to know that the total market cap of all the gold bullion in all of the world's exchange-traded funds is just less than 400 billion US. That is less than 1/10 of the Nvidia market cap. That is less than 1% of the S&P 500's market cap. It is totally insignificant. And where we have a range of different uncertainties in markets, where there would appear to be elevated potential of an economic slowdown in the US, where there may be elevated potential, there are more economists talking about a bout of stagflation in the US, that would be a motivator to many investors in financial markets to seek a defensive asset class such as gold bullion. So we see a variety of different demand sources from the top down that will maintain a level of elevated demand for gold bullion. Then we look at the supply side. The supply side, we reflect, has experienced a period of underinvestment for almost 15 years since the end of the last cycle in 2011. And there has been less exploration, less replacement of ounces that have been produced, less development of new mines. The supply side, we would observe, is less able to respond to shocks. And then there is the ultimate supply rebalancing to higher prices that we started describing before. The first phase is many producers lower the grade that they're producing, reduce production to extend mine life. That contracts supply and steepens the cost curve. That's phase one. Phase two is, and we're in that phase now, phase two is where net new supply starts coming to the market, and that's through brownfield expansion of existing mines. The minimum lead time for that is 2 to 3 years. The third phase is brand new greenfield mines. The minimum lead time for that is 5 to 6 years. So when we look at this period of we've seen strengthening gold prices, we see demand supporting and continuing to support an elevated level of demand. We see a supply side that will take time to rebalance, and that equals much materially higher gold prices on a 2, 3, 5 year view.
So the fund has, in your opinion, got at least another 5 years in it, and then by that time, as we're marching towards that, new catalysts might be emerging, etc. So what would make you decide to close it?
And return capital to shareholders, where our research analysis of the gold market is that demand has waned or is waning, or that supply response is there, so that that supply is exceeding demand and placing downward pressure on price. That would be the main factor, combined with the equities that are fully reflecting, or we often say in markets that the pendulum swings further than the fundamentals. At the peak of the last cycle in 2011, on if we look at the top 5 gold miners as a good proxy, because they are long life, very competitive companies, the peak of the last cycle, that cohort was trading on an average of 29 times 1 year forward price to free cash flow at spot gold. That's a very full price. The pendulum has swung a little bit further than fundamentals. We would say that the fundamentals for a long life, low cost, competitive cost gold mining company would be low 20s if the market is trading on somewhere between 16 and 18, if the general equity market is trading on 16 to 18 times. That same cohort of top 5 gold miners today are trading on less than 10 times 1 year forward price to free cash flow. So as those valuations start to reflect fair value or even push through fair value, that will be another key motivator to shutting the fund and returning capital.
What would you open next? If you had to crystal ball, Roscoe has closed the gold fund. What do you think takes its place?
Too difficult to say. Let's see what
a crypto fund, surely.
Let's see what transpires between then and now.
Roscoe, this has been really interesting. Right, there's a couple of questions that Owen, a question that Owen always asks, and one that I always ask my guests when they're on the podcast for the first time. Owen's one. Roscoe, if you could go back in time and tell your younger self something about life, investing, business, or anything, what would it be?
Pass. That's look. I was trying to come up with something witty.
Doesn't have to be witty.
No, stick to your guns. Don't be afraid to be different.
And do you have a favourite investing book?
No.
You don't?
Favourite investing people.
Who's your favourite investing people?
We at Triple Eight Capital have built an advisory board with what we describe as the grey hair, people who've seen more cycles within their industries than ours, and who remain actively engaged with their industries in the world. And it's with people like that we get the most insights.
Who is on your board?
Our advisory board and management company board is chaired by Lee Clifford, former chair of Qantas, former chief executive of Rio Tinto. On the gold advisory board, we have Jim Askew, really one of the most experienced mid-cap gold mining non-executives and executives going around.
What have they brought any lessons to the table that you probably wouldn't have gotten otherwise?
Constantly. And we have an active process. They are part of the process of engaging with what we're doing and how we're doing it. They provide non-fiduciary oversight of what we do and how we do it. And we would say that our process can identify plenty of ideas. There are plenty of ideas on how we can take risk. But what we benefit so much from is their perspectives on what can go wrong because of what has gone wrong in the past. They are an excellent sounding board for that. So I would say less about investing books and more about
the people you surround yourself with.
Unique investing people. And we've got so much respect for grey hair and people who've seen it before.
Awesome. And finally, Roscoe, me and you are going to go for lunch somewhere. The out of office is on. We're not coming back. Where are we going and what are we having?
We would go to Scopri.
I know Scopri.
I think it's the best. I think it's the best.
On Nicholson Street, yeah?
Yeah. I think it's Nicholson Street. Best Italian in Australia.
Really?
Yeah.
I've heard so many people say so many good things about it, and I've never been. And it's very close. And you know they open up a little wine bar not too long ago. Have you been there? It's just a couple of doors down. Apparently, it's excellent. I can't remember the name of it. Fantastic. Well, Roscoe, thanks for joining us today and giving us that's a really thorough deep dive on gold, the drivers of it, and I just love the openness of the willingness as well to close the fund. I think that's once it's run its useful life, job done. We move on. I think that's a really interesting and wonderful approach to actually managing funds. Excellent. Thanks for joining us, mate.
Thank you for having me.
Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.